Well, bond prices are higher after the Fed unexpectedly raised its discount rate. At least the timing was unexpected. Equity futures are down right now. Michael Pond is interest rate strategist at Barclays, joining us with reaction from his offices here in New York. Mike, good to talk with you again.
Good morning.
We were talking to Mike McKee earlier about this change and what it means for the markets. I mean, essentially, the Fed was accommodating what the markets were doing already, right? Because a lot of banks were not borrowing anymore from the discount window.
That's right. So only about $14 billion of the Fed's $2.3 trillion balance sheet is money through the discount window. So it's a relatively small part of Fed operations, but it is a signal that the Fed is slowly but surely removing the extreme policy combination that was put in place during crisis times. We're no longer in a crisis. There's still some uncertainties regarding the recovery, but clearly we're no longer in a financial crisis, and some of these policies are just not necessary.
They're not, and certainly it's expected because the Fed has been jawboning this for quite some time, that they are going to be removing some of these emergency measures. But does this sort of increase the rate at which they're going to remove these measures and raise interest rates?
We don't think so. Again, the actual move comes as no surprise to the market. Chairman Bernanke addressed this 2 weeks ago in his testimony. This was reiterated in the FOMC minutes that we got earlier this week. So the actual move is no surprise, but the timing is. So, you've got to wonder whether the Fed wants to test out the markets, put a little bit of uncertainty in the markets, and see how the markets react to see how quickly they can remove a policy accommodation.
But does this really add uncertainty, Mike? I mean, isn't this in a way the Fed...
It's a timing perspective. When Chairman Bernanke said sometime in the near term we might need to raise the discount rate, I think few thought that meant 2 weeks from now they'd be doing so. It was more expected at the next FOMC meeting or sometime over the next couple months rather than 2 weeks from then. So it is uncertainty from a timing perspective, but the actual move was well telegraphed.
Okay, so and that's exactly the way I've seen it as well.
Right.
But with the bond, okay, so given that then, Mike, then for the bond trade, let's just take the bond trade first, because you did see the yield gap between the 10 and the 2, I think trade at a record or something of that nature in the last few sessions. How will bonds trade from here on out then, given this extra uncertainty?
That's right. So the 2's 10s curve increased. The spread between the 2-year and the 10-year moved up to 292 yesterday, 292 basis points. That's an all-time record, and that reversed a bit after the Fed made that surprise announcement, a surprise from the timing perspective anyway, because it provides uncertainty as to how quickly the Fed will be moving rates higher. We think they still will be moving in September, the Fed funds rate, that is. Right.
But does that make bonds a good short then, is what I'm saying?
At the long end, we think it still does. We think the long end will still come under pressure from continued supply. And while the supply next week is concentrated in the short end, at least in nominal space, we get the first 30-year TIPS auction since October 2001 next week. But the nominal supply is concentrated in the short end next week. But the front end of the curve is flush with cash, and that's where the demand is, so that the short end auction should continue to go well. It's the long end that we're more concerned about, and we think investors should stick with curve steepeners and shorts in longer dated treasuries.
Okay, Mike, thanks so much. Good to talk with you. Michael Pond of Barclays, interest rate strategist.